Hi everybody, this is Thomas Wynn, CEO of Wynn Capital with the second quarter market review. I'm going to jump right in and take a look at a chart of the stock market for the last year. On your screen now is 1 year of the spiders, the S&P 500 ETF. There's the last half of 2013, the first quarter of 14 up a little bit, and 2014 second quarter, a pretty strong quarter, about 5 or 6% for the US large cap. And you can see still drifting higher in the third quarter. I want to contrast this with this long-term chart. This goes all the way back to 1994 and shows the internet rally and the bear market that followed, the real estate rally and the meltdown that followed. And here we are with almost 200% returns over the last 5 years. We're definitely overvalued, and unlike other firms that raise cash and take money off the table, we allow our clients to stay fully invested or appropriately invested, and we attempt to hedge using option strategies. That allows us to give up only a fraction of future gains if they materialize and still mitigate risk in case something happens. So my clients know that I don't know how to predict when a bull market will end. I don't know if we're 1 day, 1 week, 1 year, or 5 years away from the eventual recession or decline that will always come after bull markets. But we do hedge every day, and we do look at the markets every day, and we're attempting very hard to mitigate the risk that our clients have to endure. So let's go look at our performance for the quarter. This chart shows in blue Wynn Capital's return, the returns of the Dow Jones global benchmarks that are similarly invested. For instance, this is our aggressive clients made 3.3% in the quarter, and that is after all fees. And the benchmark made 4.99, and you can see the rest of the models that we have from aggressive all the way down to ultra conservative. We trailed in every category except almost matching our fixed income category. We'll get into the whys when we see the market summary, but in general, small cap and value stocks, which we overweight through our DFA funds, perform poorly. And we'll take a look at some charts on that in a second. But when you're trying to outperform the market, you have to do something different than your benchmarks, and you're going to have quarters like this where you trail. We can contrast that with the first quarter or the fourth quarter of 2013 when we beat our benchmarks for the opposite reason. Small cap and things that we did, overweighting US and other things, allowed us to outperform. And of course, for the year, we had great returns, beating our benchmarks, and due to our hedging, only had a fraction of the risk that similar investors had. So let's just review real quickly part of the reason why we use DFA funds. This chart shows US indices from way back in 27 up until 2012. And value stocks beat the S&P 500 and growth stocks. Most people assume that growth beats value. Value implies conservative and growth implies risk. It's actually the opposite. Value stocks have more risk than growth stocks. Because of that and other reasons, you're rewarded for taking more risk. Value stocks tend to be trading below their fair value, and they're trading below their fair value for various reasons. Usually, the company's in trouble for one reason or another. They're risky, and investors have shunned them, and they trade for low prices. Historically, if you buy value stocks as opposed to growth stocks over long periods of time, you'll be rewarded. That's what we do. It is persistent, enduring dimension of return, and that's why we are overweighted, tilted towards value. In the small category, it's even more pronounced. Small value beats small growth. Even in the non-US markets, the phenomenon is still slightly prevalent, and in emerging markets, it's very prevalent. And if you look at small versus large, you can see that even in the US, in the US or any markets, small and value beat large and growth. So we tilt that direction, but it's not a day-to-day, month-to-month, quarter-to-quarter. It is persistent, but over short periods of time, it can let you underperform, which is what happened this quarter. And basically, we also want to see that going back all the way to the 80s and sometimes the 90s for the funds that DFA has, and many of these funds are in our portfolios, they've just had persistent, consistent outperformance over long periods of time. And the numbers are right there. You can take a look at them at your leisure. So I'm going to jump into the summary, and let's take a look at what happened in the market. So we're all familiar with these slides by now. There's 6 asset classes that are summarized right here, and every asset class was up, from the U.S. market to the foreign to emerging markets. Real estate had a big quarter. The bonds were up big, both global and U.S. This is the chart of the market and the news associated with the market. Like most quarters, there was tons of news, but the market just chugged along and basically ignored bad news and I guess took to heart good news. This is a little more than 6 asset classes. This is 10 or 15 asset classes here, and it shows that real estate, 2 real estate investments had fantastic quarters, and even emerging markets, which has been bad for 2 years or so, had a great quarter. And we could see S&P large cap US in the middle of the pack, and the one that we're overweighted did poorest, and that's why we trailed in the quarter. And now we'll look at US stocks all by themselves, and again, small value, small growth, everything in the small area underperformed markedly versus all the other categories. Same thing was true in international developed. Big quarter again in foreign developed. Small cap just lagged a little bit. Then we look at the various countries, always volatile. Some countries down 8 and change, some countries up 10. In the emerging market, very volatile as usual, with big returns in some countries and negative returns in other countries. Real estate this quarter, we have an appropriate allocation of real estate, so we captured some of these gains. Really big returns in the real estate area. Commodities, a mixed bag, as some metals were up in the quarter and other commodities, food commodities, were down in the quarter. Very dangerous, but we own the appropriate global asset allocations in commodities as well. Emerging markets finally having a good quarter. We still have not raised our allocation in this area. We've been underweighted and have benefited from that, and we're still trying to decide whether this is a one-quarter phenomenon or whether we should return to equal weighting in emerging markets. The news is very volatile and it's difficult to make a decision, but so far we haven't made a move, and I'll let clients know if we do make a move in that direction. Fixed income, interest rates declined sharply in the quarter, which makes bond returns jump. So some of the bond returns year to date have been very good. If everyone remembers last year at this time, we had negative returns, almost the inverse of this. Long-term bonds were down 13% last year, making a comeback this year. It's a little bit puzzling to have interest rates declining so sharply, almost to the levels on the 30-year bond. The 30-year bond is on here, I think, 3.34%. We went under 3% during the crisis, and we're approaching those levels again, which is interesting to have such a strong economy and a strong stock market with lower and lower and lower interest rates. It's a little bit puzzling for most of us. I'll go into that more at a later time. This is an article about the media. DFA often will try to get investors to focus on things they can control, not the things they can't control, and understanding that the media's job is to sell products and to gather eyeballs, not really to educate anybody. So I always enjoy these articles. I think they're well written, and I think you do well to take a look. So that is it basically for the summary. I hope you find the material helpful, and I'm available anytime if you have questions. I'll be following up with everybody in the coming weeks, and I look forward to talking to you all soon. Thank you very much. Bye-bye.